Hello everyone. In this business studies video, we are going to discuss Chapter 20, Cash Flow Forecasting and Working Capital. The cash flow. The cash flow of a business is its cash inflows and cash outflows over a period of time. What are cash inflows? These are the sums of money received by the business over a period of time. In simple words, cash inflow is the cash income to the business. How can the income be made? One of the sources is through the sales revenue. Sales revenue is the revenue that can be generated from selling of the goods. How to calculate the sales revenue? Unit selling price multiplied by the total number of units sold. Debtors. These are the customers who have purchased the goods and the payments are yet to be made to the business. Money borrowed. Money can be borrowed through some external sources or from the bank. For example, bank loans. The money that can be made from sale of the business assets. For example, fixed assets like building, machinery and the land, which are of no use or they don't contribute anymore to the factors of production, can be sold and make some money out of it, which can make a contribution to the business cash inflows. Investors. Investors are those who are interested in your business and would want to a part of your business. They are, for example, shareholders or prospective partners. Next is cash outflow. Cash outflows are the sums of money paid out by the business over a period of time. That is, how cash inflow is an income to the business, the cash outflow is an expense to the business. And these are purchasing goods and raw materials for cash. To produce the finished goods, the firm has to purchase the raw materials and components from its suppliers and pay it in cash. Paying wages and salaries. One of the four factors of production is the labor, and to employ the labor, the firm has to pay wages and salaries. And the other expenses are like paying electricity bills, transportation bills or like gas bills, and purchasing fixed assets. So the other three factors of production is machinery, land and the building. To purchase these assets, the firm needs to spend its cash. Repaying loans. The money that has been borrowed before has to be repaid or the interest has to be paid at some point of time. This is also an expense. Paying the creditors. Sometimes the goods and raw materials can be borrowed from the suppliers on credit, which has to be paid at some point of time. So these are all the different types of cash outflows. To explain it better, think of it as a water tank. Water comes in at the top and drains out the bottom. So to keep your tank nice and full, you want more water coming in than going out. So it is very important to strike a balance between cash inflow and cash outflow. Otherwise, the business might face liquidity problems. It is a situation where it cannot cope up with its day-to-day expenses like paying wages, bills, suppliers, etc. The importance of cash and cash flow forecasting. So, cash inflow is the lifeblood of the business, and comes from sources like payments from customers, receipt of a loan, monetary infusions from an investor, or interest on savings or investments. Like we can see here, cash is the king. Cash is also important because it later becomes the payment for the things that make your business run. For example, expenses like stock, or raw materials, employees, rent, or other operating or day-to-day expenses. So naturally, positive cash flow is preferred. Positive cash flow means your business is running smoothly. So having positive cash flow, we can always avoid the liquidation. Liquidation is a situation where selling up everything in order to pay the business debts. So liquidity is something called the ability of a firm to pay back its short-term debts. That means the liquidity is considered as the queen and the cash is considered as the king. So why cash is important to a business? To pay its day-to-day expenses like the employees' salaries, to pay suppliers for the raw materials and components they supply, to pay the rents and the electricity bills and the other costs for its premises. So all of these day-to-day expenses, like every day you should have enough cash to run these expenses. So these day-to-day expenses are also called the working capital. Positive and negative cash flow. A positive cash flow where cash inflow is more than the cash outflow, which means the business revenue is more than the business expenses. For example, if your salary is say $5,000 per month, which is your income, and your expenses for that month is $3,000, so you have a saving of $2,000. So that means you have a positive cash flow. And negative cash flow is a situation where your cash inflow is less than the cash outflow. That means your income, business income is less than the business expenses. If we can talk about the same example, your salary is $5,000, but your expenses are like $7,000. So you're in minus $2,000 debt, which is a negative cash flow. Well, people often think cash flow and the profit are the same. They are not. So what is a profit and what is a cash flow? Profit is like the income. It is shown in income statement. The costs, the total costs, which are variable costs and fixed costs, are to be deducted from the sales revenue. Then we get the net profit. So the income statement shows the profitability, whereas the cash flow statements will show the difference between the cash inflows and the cash outflows. So if you deduct cash outflows from cash inflows, you get the net cash flow. So these cash flow statements would actually give us a clear picture of the liquidity. So the income statements show the profitability and the cash flow statements show the liquidity position of a company. So the cash flow is basically a cycle. Let's see how. The company needs cash to buy raw materials, components from the suppliers, to pay wages to its labor, and to pay the rent for the building or to purchase the land, etc. So by employing the 4 factors of production with the cash, the business produces the goods. Once the finished goods are made, these are sold in the market. And by selling the goods, the business again gains the money in the form of sales revenue. And this sales revenue becomes the cash which is needed to buy the raw materials and components with which the goods are produced and sold. So this is how the cash flow cycle works with the continuous flow of cash inflow and the outflow. Cash flow forecasts. A cash flow forecast is an estimation of future cash inflows and outflows of a business. It is usually done on monthly basis, and this can help the manager to know how much cash is actually available to pay for the bills, to pay for the creditors, or if we have to purchase any fixed assets, or to repay the bank loans. It will also give a clear picture to the manager if a business is running out of cash, which is also known as illiquidity position. Then how can we can overcome by borrowing the money? How much cash that we need to borrow it from the bank or any other financial sources. It will help us to know whether the business has too much cash tied up in the form of inventory or in the form of unused fixed assets, which can be sold and make money, which can be put into a profitable use to the business. Cash flow statements. Let's see how do we do the cash flow statements by an example here. Here is an example of a company wherein the cash flow statements are done for each month, August, September, October, and so on. So the cash inflow, you know that the cash inflow is the income to the business in the form of its sales revenue. So this is the cash sales, which are also known as the sales revenue here, okay, which is $70,000 here. And then the cash outflows, which are the expenses of the business. Wages to the employees, $20,000. And then plants and trees purchased, $20,000. Seeds and compost, $0. Heating and water, it's $1,000. The tax on the land, it's $100. So the total cash outflow is, here it's $41,100. So how do we get the net cash flow? Here is the net cash flow. You have to deduct the total cash outflow from the total cash inflow. So how much is the total cash outflow? $41,100 minus $70,000, which is the total cash inflow. So if you deduct this from this, the net cash flow would be $28,900. So there is something called the opening bank balance. Opening bank balance is the amount of cash held by the business at the start of the month. So this is $100. So if you add $100 to the net cash flow, that becomes the closing bank balance for the month of August. I want you to remember one thing. This month's closing balance will be the next month's opening balance. For example, for August month, the closing bank balance is $29,000, which would be the September's opening bank balance, 29,000. It's the same, okay? And September's closing bank balance will be the October's opening bank balance. So this is how the cash flow statements can be done. How to overcome cash flow problems, or what should a company do if it has a negative cash flow? You all know that the negative cash flow will lead to the firm into liquidity problems or illiquidity condition, which means the firm will run out of cash to carry on its day-to-day expenses or the working capital. So how do we overcome such problems? By one of them is increasing bank loans. So by borrowing more money from the banks can temporarily put the business out of danger, but in the long run it will make the company to pay a lot of interest rates on it, which will eventually might lead to a lot of cash outflow. And then delaying payments to the suppliers. So when the business buy its raw materials and components from the supplier, instead of paying either in cash or in short-term credits, it should go for a long-term credit where it can delay its payments for some more time. This will probably put the company temporarily out of trouble, but this would also make the suppliers refuse to supply because of delayed payments, or sometimes the supplier could also offer lower discounts for its late payments. Another solution is asking the debtors to pay more quickly. So the debtors are no one but the customers who have purchased the finished products, but they haven't paid yet. So by asking the customers to pay by cash or to make the payments immediately would definitely help the firm to overcome the cash flow problems. But in the long run, the customers might not like this, or the business might lose its customers to its competitors, where the customers can have the needed products from the competitors on a long-term trade credit. And delay or cancel purchases of capital equipment. Capital equipment is, for example, machinery. So you can delay the purchase of the capital equipment for some time so that you don't have to spend a lot of money on it. But this will eventually lead in the long run of decreased efficiency or productivity. So this might again increase the cost of production, which will force the selling price to be more, and it might lead to lose the customers to its competitors. The last topic of this chapter is working capital. Working capital is the money required by the business to pay its short-term day-to-day expenses. So working capital can also be calculated by deducting current liabilities from current assets. So current assets include cash at hand, short-term debts, trade debtors, inventory, and other assets that can be quickly converted into cash, say within a year. And current liabilities are those which include trade creditors, short-term debts, accounts payable, and other liabilities which are to be paid off in less than a year. So the working capital is basically it's the money, it's the capital is all of the liquid assets of the business. The assets that can be quickly converted to cash to pay off the business debts. So the working capital can be in the form of cash at hand, which is needed to pay its expenses. For example, employees' wages and salaries, electricity bills, gas bills, etc. Cash due from debtors. Debtors are the customers of the business who have purchased the finished goods and the payments yet to be made. And cash in the form of inventory. Inventory of finished goods can be quickly sold off to build cash inflows. There is a point that is to be noted. Too much inventory results in high costs because too much inventory, which is inventory of finished goods, which is more than the required demand, will result into the cash tied up in the form of inventory, which will also hike the business costs. And on the other hand, too low of an inventory may cause production to stop, because what if there are not enough raw materials and components to carry on the production? Then the production will come to a halt, and other resources, other factors of production like the labor, land and building, these resources will sit idle in waiting for the rest of the inventory to come and continue the production. So with this we come to an end of this chapter. I thank you all so much for watching this video and hoping to see you all in my next video. Thank you.